Welcome to the Deep Dive, where we shortcut your path to becoming well-informed. Today, we're unpacking a stack of pretty complex sources focused on Keurig Dr. Pepper Inc., KDP. This is the North American beverage titan forged from that massive 2018 merger. And we're looking at a company that is, well, currently making its second great transformational gamble.
Right. Our mission today is really to decode what we're calling the KDP paradox because, on paper, this company looks like a resounding success. Since the merger, KDP has delivered a remarkable 64% total shareholder return through 2024. That nearly doubles the 36% average return of its peer group. Pretty impressive.
64% versus 36. Okay, yeah.
And the initial integration itself, it was, well, basically flawless. They hit or exceeded every key three-year target. We're talking a healthy 6% in net sales CAGR, and critically, they slashed management leverage. Remember how high that was?
Oh, yeah, it was huge, right?
Terrifyingly high, 6.0x. They got that down to a much more manageable 2.9x by 2022.
Okay, so that sounds like an investment dream, doesn't it? A company takes on massive debt, executes a textbook integration, delivers market-beating returns. So where's the paradox hiding? What's the core instability that this, successful integration didn't actually fix?
Well, the instability is systemic, and it's fundamentally strategic. The paradox is that all this success has been built on a persistent structural tension, a tension between its two core operational pillars, the cold beverage business and the coffee business.
Oh, okay.
The cold beverage arm, think Dr. Pepper, is immensely strong, generates tons of cash, and it has effectively been subsidizing and compensating for the, let's say, high commodity risk and the performance volatility of the coffee arm, the Keurig side.
So one side is propping up the other, basically.
Exactly. And management recognized that this internal conflict was putting, a permanent ceiling on their valuation multiple. They just weren't getting the credit they thought they deserved compared to peers. So to unlock that next level of shareholder value, to finally trade more in line with the global giants, they determined they had to take this dramatically risky step.
Which is?
A transformational corporate separation. Success, in this case, actually necessitated tearing the company apart.
Wow. That's quite a narrative.
Yeah.
A corporate divorce initiated not because of failure, but because the success itself created a ceiling. Okay, so to understand this impending split, we really have to understand the business structure itself first. KDP is, it's a complex organization split into three main segments, right? Let's identify the engine of stability and the source of that strategic drag you mentioned.
Absolutely. And the proportional size of these segments really tells a story. It tells you exactly where the core health of the company lies.
All right, so let's start with the biggest one. The undisputed heavyweight champ, the anchor of the whole enterprise. That's the U.S. refreshment beverages segment. This is the true stable engine, right?
Okay.
Contributing a dominating 60.8% of fiscal year 2024 revenue.
That's the one. 60.8%. And when we talk about this segment, it's the core carbonated soft drinks, Dr. Pepper, 7UP, Canada Dry, A&W, Sunkist, the classics. But also, importantly, those high-growth non-carbonated drivers that have really expanded their footprint. Things like Snapple, Bai, Core Hydration, and Mott's.
Okay, so a mix of old and new within that segment.
Precisely. And it operates like a classic consumer staples machine, manufacturing and distributing concentrates, syrups, finished beverages. It goes out to a network of third-party bottlers, distributors, retailers. It's consistent, it's reliable, and critically, consistently delivers robust growth.
And the numbers back that up.
They do. In fiscal year 2024, this segment posted a strong 5.8% net sales increase. This consistent, resilient performance is the core cash-generative machine. That's what paid down the initial merger debt. And importantly, it provides the financial stability needed for this high-risk pivot the company is now undertaking.
Okay, so that's the stable 60%. Now let's pivot to the segment causing the strategic friction, U.S. coffee. Still significant, you said, generating 25.8% of fiscal 2024 revenue.
Yeah.
But its business model, you called it a double-edged sword, powerful when things are good, but vulnerable.
Exactly. It's the textbook application of the razor and blade model. The foundation is the Keurig single-serve system. They sell the brewers, that's the razor, which then drives this high-margin recurring revenue from K-Cup pod sales. The blade...
Right, the pods are where the real money is.
Absolutely. And the competitive advantage created by this lock-in, it's almost unparalleled in the beverage space. KDP has an installed base of approximately 40 million U.S. households owning a Keurig brewer. That's as of year-end 2023.
40 million households. That's enormous.
It's a huge, captive, high-frequency revenue stream.
Okay, so if that installed base is so massive, why are we calling the segment volatile? That sounds like structural invincibility, doesn't it?
Well, structural invincibility doesn't always beat external habits and commodity price shocks. The volatility is driven by two major headwinds hitting the segment basically at the same time.
Okay, what were they?
First, the post-pandemic normalization of consumer habits. Think about it. During lockdowns, people drank pretty much all their coffee at home, right?
Sure. Yeah, offices were closed.
Right. So as mobility returns, people going back to the office, grabbing coffee shop drinks on their commute, just dining out more, the whole at-home coffee category has muted significantly.
Yeah.
This is a fundamental reversal of what was a massive temporary tailwind for them during the pandemic years.
Okay, that makes sense. The peak was unnatural. And what's compounding the difficulty? You mentioned two things.
Price. They were simultaneously grappling with, and the sources used this phrase, record green coffee inflation throughout this period.
Ouch. So demand weakening and costs rising.
Exactly. You have the demand signal weakening because mobility is returning and your input costs are rising sharply. The combined result. The U.S. coffee segment actually recorded a 2.6% net sales decline in fiscal year 2024.
A decline, while the beverage side grew almost 6%.
Precisely. That divergence, 60% of the business growing strongly, being financially dragged down by a declining 26% segment that's fighting massive inflation, that's the primary strategic imperative. That's what forced management's hand towards this transformational decision.
Okay. And finally, there's the smallest segment, the international arm. This gives us maybe a glimpse into KDP's global aspirations.
Yeah, the international segment, it represents about 13.4% of revenue, and it's actually quite geographically concentrated, despite the name. Primarily focused in North America, the U.S. and Canada account for like 95% of its total revenue.
Oh, okay. So not that international yet.
Not really, mostly Canada and Mexico. But it is demonstrating strong underlying growth momentum. In fiscal year 2023, it delivered a healthy 10.5% net sales growth on a constant currency basis. That's fueled by core brands like Canada Dry and Dr. Pepper in the northern markets, and also Peñafiel in Mexico, which is a leading carbonated mineral water brand down there.
So even though it's small, its success kind of validates the idea that KDP brands can travel beyond the U.S. border.
Exactly. It fuels the ambition for the global scale we're going to talk about later with the big acquisition.
Okay. That strong performance in specific niches leads us perfectly into the competitive arena. KDP is the third largest non-alcoholic beverage company in North America. But its strategy isn't just to beat Coke or Pepsi head-to-head everywhere, is it? It seems designed to exploit specific defensible moats.
That's right. And to really appreciate their position, you have to recognize the scope of the market they're playing in. The global beverage market is just gargantuan. It's projected to grow from roughly $1.92 trillion in 2025. Trillion, yeah. So over $2.56 trillion by 2030. That's a nearly 6% compound annual growth rate. And that relentless growth means there's relentless pressure to adapt to these massive consumer shifts that are happening.
Okay, and the sources highlight three big trends demanding innovation. The first one, probably the most pervasive, is health and wellness.
Precisely. This is huge. We are seeing a structural shift away from traditional high-sugar CSDs, carbonated soft drinks, towards functional waters, low-sugar alternatives, and even what's termed the sober curious movement, people cutting back on alcohol.
Right, looking for sophisticated non-alcoholic options.
Exactly. And KDP is trying hard to catch this wave because these non-alcoholic segments, they're seeing double-digit growth rates, far outpacing legacy brands. You know, the Snapple impairment charge we'll discuss soon is actually a direct consequence of, well, failing to pivot quickly enough to this very trend.
Interesting connection. Okay, second trend, premiumization and experience.
Yeah, consumers today, they seem to demand more unique, crafted experiences, and they're often willing to pay more for them. Think about craft sodas, unique flavor combinations, the explosion of ready-to-drink or RTD cocktails, which sits kind of adjacent to their market. KDP has to continually innovate its core brands, like Dr. Pepper, with new limited-time flavors just to satisfy this constant need for newness.
Keep things fresh. And the third major force, which sounds critical for their coffee business, is sustainability.
Oh, absolutely critical. The focus on RPE, that's recycled PE plastic and aluminum cans, it's no longer just a fringe consideration. It's becoming a core purchasing driver, particularly for younger demographics. They really care about this stuff. And KDP, especially through Keurig, has been historically quite vulnerable to environmental scrutiny, all those plastic pods.
Yeah, that's been a constant criticism.
It has. And its strategic move toward the new K-rounds, these compostable pods, is a direct response to this immense pressure. We'll touch on that more.
Okay, so operating in this huge shifting market, Let's talk about KDP's competitive moats. What are these formidable barriers that let them coexist and even thrive against giants like Coke and Pepsi?
Well, the foundation, I'd say, is brand equity. This is the moat that's almost impossible to replicate. Dr. Pepper, for example, it's been around for over 139 years. That history translates into deep, sometimes almost non-rational consumer loyalty.
People just love their Dr. Pepper.
They do, and that acts as an incredibly powerful defense against private label brands, right? The store brands can undercut on price, but they can never replicate that history and trust.
Makes sense. Okay, the second moat is more technological and economic. The Keurig ecosystem lock-in.
Yeah, this is the genius of that razor and blade model executed at massive scale, those 40 million installed brewers. They represent a sunk cost for consumers. Once you own a Keurig machine, you are heavily incentivized to keep buying the K-Cup pods, which, as we said, are the high-margin recurring revenue stream.
Because buying a whole new system is a hassle and expensive.
Exactly. And this lock-in is so powerful that KDP-manufactured pods command approximately 80% dollar share of the entire U.S. retail market for tracked channels.
80%, wow.
It's an almost perfect captive audience. Very hard for competitors to break into that system.
Okay. Brand equity, Keurig lock-in. And the third moat, the one that sounds capital intensive and hard to build, is their distribution network.
Yes, KDP's hybrid distribution model, and specifically its direct store delivery network, usually called DSD, is truly a scarce asset in this industry. To really understand why it's such a moat, you have to grasp the difference between DSD and, say, standard warehouse delivery.
Okay, break that down for us, because I think a lot of listeners probably assume, delivery is just delivery. Truck shows up, drops off stuff.
It's really not, especially for beverages. Standard delivery or warehouse management systems, WMS, involves trucking big pallets of product to a retailer's central distribution center, like a giant warehouse. Then, the retailer's own staff handles restocking the shelves in individual stores, merchandising, all that.
Okay, so KDP sends it to Walmart's warehouse, and Walmart handles it from there.
Right. But DSD, direct store delivery, is different. That involves KDP, or one of its authorized bottlers, trucking the product directly to the individual store. Their person goes in, checks the inventory on the shelf, stocks the shelves, maybe sets up a promotional display, rotates the product to ensure freshness. The whole 9 yards, right there in the aisle.
Ah, much more hands-on. So why is DSD so much better for things like sodas?
It guarantees optimal shelf presence. Think about it.
Yeah.
The person stocking the shelf is your employee or your bottler's employee. They are highly incentivized to put your product, say, Dr. Pepper, right at eye level. Make sure the cold vault is fully loaded, ensure the display looks great. This is absolutely critical for impulse purchases, like grabbing a cold beverage.
You see it, you grab it.
Exactly. And smaller players. They simply cannot afford the massive capital investment required for the fleets of trucks, the local warehouses, the localized sales teams needed for a full DSD footprint. It's a huge physical barrier to entry.
Okay, that makes the DSD network sound incredibly valuable. And this leads us right to what you call the most fascinating competitive story happening right now.
Yeah.
The Dr. Pepper breakthrough and its underlying strategic vulnerability.
Yes, this is really the pinnacle of the KDP beverage story so far. In 2023, the Dr. Pepper brand achieved this landmark shift. It actually surpassed Pepsi to become the #2 best-selling soda brand in the U.S. by sales volume.
Number 2, ahead of Pepsi.
Ahead of Pepsi, Dr. Pepper captured 8.34% market share, just edging out Pepsi's 8.31%, still trailing the undisputed market leader, Coca-Cola Classic, which is way up at 19.2%, but still, beating Pepsi is massive.
That is historic. But
Yeah.
hang on. How did KDP, the smaller competitor, achieve that kind of penetration, especially given what we just established about how crucial the DSD network is, and KDP's network is smaller than Coke's or Pepsi's, right?
That's the anomaly. That's the fascinating part. Dr. Pepper's ubiquitous presence, the reason you find it everywhere, is achieved via this unique historical distribution arrangement. KDP actually relies on the bottling and distribution networks of its primary competitors, Coca-Cola and PepsiCo, in key territories where KDP itself lacks its own DSD system.
Wait. You're telling me that the rival, who just lost the #2 spot, Pepsi, is actually responsible in some places for stocking and selling the product that beat them?
In many territories, yes. This arrangement dates back decades to times when Dr. Pepper was classified differently than colas, allowing it to kind of piggyback on competitors' infrastructure.
That seems, like an almost non-negotiable strategic vulnerability, doesn't
It
it?
absolutely is. While it's incredibly efficient from a cost perspective, KDP doesn't have to build out expensive new infrastructure across the entire US. That efficiency is tied directly to inherent channel conflict. You just hit on the key risk.
Yeah, I mean, if you are a Coke or Pepsi bottler and Dr. Pepper is clearly cutting into your core cola business, what stops you from just deprioritizing their product, making it harder to find?
Strategically, nothing, really. And deprioritization doesn't necessarily mean pulling the product entirely. It's more subtle than that. It means controlling its shelf visibility. It means, subtly ensuring that their new competing flavored CSDs, let's say, a new Pepsi variant gets the prime eye level spot, the best cold vault placement, while Dr. Pepper maybe gets placed lower down, or maybe less product is left to rotate onto the shelves so it sells out faster.
The little things that make a big difference in sales.
Exactly. This threat of deprioritization is persistent and very real. It places a kind of strategic cap on KDP's potential growth, a cap that only significant investment in its own DSD network can truly fix. That's why KDP leadership constantly emphasizes DSD expansion in their investor briefings and earnings calls. It's all about mitigating the single greatest dependency risk they have.
Okay, that context makes this whole strategic pivot, this separation plan, even more intriguing. It's a company that has succeeded despite its dependencies and its internal segment friction, and now it's willing to take on massive new risk to solve both problems at the same time. But before we dive fully into the future plan, let's quickly look at the company's recent financial history, because you mentioned 2023 had a major anomaly that really requires explanation.
Right, we should first acknowledge the baseline financial health, though. From 2018 to 2023, KDP showed impressive consistency. Revenue expanded from about $11 billion pro forma to $14.81 billion. That maintained that solid 6% CAGR we mentioned earlier. And crucially, they demonstrated superior pricing power during that recent inflationary period.
Okay, let's define pricing power in this context. What does that actually mean?
Well, in 2023, KDP's net sales grew 5.4%. But, and this is key, that growth was almost entirely driven by a really robust 7.0% increase in net price realization. They raised prices significantly.
7% price hikes, and people still bought it.
Yes, this massive price hike was successful in offsetting a 2.1% decline in their overall sales volume and mix. So fewer units sold, but much higher prices per unit. What that tells us is that the price elasticity of their core brands, especially Dr. Pepper, is very low. Consumers are highly loyal. They kept buying, even with those higher prices.
Okay, so the brands are strong enough to handle price increases.
And this pricing action successfully covered that input cost inflation we talked about. We know this because their adjusted gross margin actually expanded by 150 basis points in the year. They hit a healthy 54.5% JAP gross margin overall.
Strong brands, strong margins. Got it. Now for the curveball you mentioned, the 2023 cash flow anomaly. If you just glance at the headline numbers, operating cash flow, OCF, dropped dramatically. It plunged from $2.84 billion in 2022 down to just $1.3 billion in 2023. And net income, which was $2.2 billion, diverged violently from that OCF number. If you're an investor just glancing at this, you probably panic and assume some kind of operational failure.
Yeah, absolutely. That panic would be understandable, but it would be wrong. This was not an operational failure in the core business execution. It was actually a voluntary strategic management decision that caused this one-time financial plunge.
Okay, what was that decision? And why did it cost so much in terms of cash flow?
Management proactively decided to reduce its reliance on its supplier financing program. This is sometimes also known as reverse factoring. Making that move caused a massive one-time $1.6 billion use of cash from their accounts payable.
Okay, let's drill down on that. What exactly is a supplier financing program, and why would reducing it cost $1.6 billion in cash right away?
Okay, think of it this way. When KDP buys, say, aluminum cans or coffee beans from a supplier, they typically have maybe 60 to 90 days to pay that invoice, right? Standard payment terms. Supplier financing involves a third-party bank stepping in. The bank pays KDP's supplier immediately, maybe taking a slight discount for paying early. KDP then pays the bank back, but maybe 90 or 120 days later, so they get extended terms.
Ah, okay. So KDP gets to hold on to its cash longer, the supplier gets paid faster, and the bank makes a little bit in the middle.
Exactly. But for accounting purposes, this can sometimes make a company's operating cash flow look better than it actually is, because they're essentially stretching out their payment terms using the supplier's balance sheet via the bank to manage their own working capital.
So it's a kind of short-term, almost invisible financing that flatters the OCF statement.
Precisely. But analysts and credit rating agencies, They generally despise these arrangements. They feel it obscures the true state of a company's liquidity and working capital management. It's often viewed as a form of off-balance sheet debt.
Okay, so KDP decided to unwind a big chunk of this program.
Yes. And that $1.6 billion was the cash KDP had to spend immediately to clear those outstanding supplier bank obligations that were part of the program being reduced. That's why OCF dropped so suddenly and sharply.
So although the headline number looks terrible, your expert analysis is that this is actually a massive positive signal, a sign of long-term financial discipline.
Exactly that. KDP basically sacrificed short-term cash flow metrics for long-term transparency and improved balance sheet quality. They're cleaning up the financial plumbing, which is usually a strong signal of good governance and, frankly, confidence in their core business's ability to generate sufficient real cash going forward. You could argue they were positioning the balance sheet to be pristine ahead of the next major transaction, the JDE Peet's deal.
Right. Speaking of cleaning up the balance sheet, well, the opposite of a cash flow anomaly might be a strategic setback, which seems embodied by the Snapple impairment.
Yeah, this was a highly material admission of underperformance that happened in Q4 2024. KDP recognized a $718 million non-cash impairment charge, and it was related primarily to the intangible brand assets of Snapple.
$718 million, that's a huge admission. What exactly does an impairment charge like that mean for the listener?
It essentially means KDP officially recognized that the future cash flows they expected to generate from the Snapple brand, which was a cornerstone acquisition from the original Dr. Pepper Snapple merger, remember those future cash flows will no longer justify the value at which the brand was carried on their balance sheet. It's a painful public recognition that the brand is worth significantly less today than they thought it was.
Ouch. Why did Snapple specifically fail to live up to those original expectations? What's the cautionary tale here?
Well, the Snapple portfolio was very heavily tied to high-sugar juices and teas, and KDP found it immensely difficult to pivot that legacy brand quickly enough toward the rapidly growing low-sugar functional beverage categories we talked about earlier. The failure really highlights the immense difficulty and the inherent risk in trying to revitalize decades-old brands that are fundamentally misaligned with major market trends like health and wellness.
So it shows that even a company with KDP's pricing power and distribution strength can't just force consumers to buy something that runs counter to these big structural shifts.
Exactly. This massive charge serves as kind of a flashing red light regarding execution risk, doesn't it? Especially just as they embark on an even larger, more complicated global merger and integration.
That's a good point. Now, the company navigated these financial currents while also undergoing a pretty significant leadership transition, right?
Yes, planned succession. Robert J. Gamgort, who was really the architect of the original 2018 merger, he transitioned to executive chairman. And Tim Kofer, who was the former COO and knew the business inside out, took over as CEO in Q2 2024. So that ensures continuity in strategy, which is important during such a period of change.
And we should also probably note the role of JB Holding Company here.
Yes, absolutely. JB is KDP's largest stockholder. And while they did reduce their ownership recently, down to approximately 21%, which actually increased the public float, the shares available for trading, to around 79%, their influence remains significant through board representation. That reduction in JB ownership was also seen by some as another signal to the market that KDP is maturing, becoming a more broadly held public entity. That often helps with stock liquidity and maybe broadens investor confidence.
Okay, so we've covered the internal friction, the dependencies, the financial anomalies, the leadership continuity, the strategic tension between the strong beverage business and the volatile coffee business, combined with this need for global scale. It all culminated in the transformational M&A and separation plan. At first, they kind of had to prove they could grow intelligently, right, before taking that massive leap.
That's exactly right. And that's where their white space growth strategy comes in. KDP defined white space as these high growth categories where they were historically underrepresented. Think energy drinks, sports hydration. And their genius here, arguably, was using a very capital efficient partner invest model instead of just going out and doing immediate costly acquisitions right away.
Okay, and their biggest success story with this model is probably the rapid penetration of the energy drinks market, right? They went from basically nothing,
Less than 1% market share.
to approximately 7% by Q2 2025. in just a couple of years.
Yeah, that speed is astonishing in the energy drink market, which is notoriously competitive. They achieved it through this really clever, multi-pronged approach. They did distribution partnerships, took strategic equity stakes in promising brands like C4 Energy and Black Rifle Coffee,
Hmm.
and combined that with some full acquisitions like the Ghost energy drink brand.
So why is this partner invest model so brilliant, as you put it?
Well, it's essentially de-risked R&D and market entry. KDP offers its scarce, valuable DSD network, that critical distribution advantage we discussed to these promising independent brands. In exchange, they often get equity stakes and the exclusive rights to distribute. So they get to essentially test drive these innovative brands, learn the category dynamics, validate the market potential, all with minimal upfront capital risk compared to a full acquisition.
That makes a lot of sense. Leverage their existing strength.
And it worked. The combined portfolio of these new energy and hydration brands is now over $1 billion in annual run rate net sales. It proves that their DSD network is a massive accelerator for third-party innovation.
And we see that same playbook being used in sports hydration with that Grupo Pisa partnership for the Electrolit brand.
Yep, Electrolit showing very strong momentum. Retail sales growing over 30% in Q2 2025, according to the sources. And they're even moving into really niche emerging categories like prebiotic CSDs with a brand called Bloom Pop and premium RTD coffee through a La Colombe partnership.
So this strategy proves they can leverage their existing assets, primarily that DSD network, to capture these high-growth segments without necessarily having to invent the product themselves from scratch.
Exactly. And that capital efficiency is absolutely vital, especially when you know you're facing a massive debt-fueled transaction like the one they just announced.
Right, which we're getting to. We also have to track the core brand innovation, though, right?
Yeah.
Keep the main engine running. The sources note KDP is pretty aggressively launching new flavors for its core brands, like Dr. Pepper Blackberry and 7UP Tropical as permanent additions in 2025.
Yes, and an A&W ice cream sundae as a limited time offering, or LTO. This kind of activity ensures that the big 60% engine, the refreshment beverage segment, stays humming and relevant, keeps consumers engaged.
And this innovation is also absolutely critical in that volatile coffee segment too, isn't it? You mentioned the Keurig Alta brewer and the K-Rounds.
Yes, this is potentially pivotal for the long-term health of the coffee business.
The K-Rounds. They sound like KDP's direct answer to all those environmental criticisms that have plagued the Keurig system basically since it launched. All that plastic waste.
They absolutely are. The K-Rounds are explicitly designed to be plastic and aluminum free, and importantly, fully compostable. If this launch is successful, this innovation directly addresses those long-standing environmental concerns, what some call the Keurig curse, that have been a major source of both investor and consumer scrutiny for years.
And the new brewer, the Alta.
The Alta brewer is designed to be multifunctional. It expands the system's capability beyond just simple drip coffee into things like hot and cold espresso-based drinks. So, this is their technological defense, designed to ensure those 40 million installed brewers remain relevant for the next generation of coffee drinkers, who might want more variety than just standard coffee.
Okay, so the successful execution of this white space strategy, proving they could grow smartly, provided the necessary confidence, you argue, for management to take the ultimate leap, the transformational M&A and separation plan.
This is the big one. This represents a fundamental seismic shift in KDP's scale, its geographic footprint, and its capital structure. KDP announced the acquisition of JDE Peet's, enterprise value, approximately $23 billion.
$23 billion, okay.
Yeah.
And the rationale here seems pretty simple on the surface. Global scale, right?
Exactly. KDP's existing coffee business was almost entirely North American focused. It was volatile, highly exposed to the swings of the domestic consumer. JDE Peet's, on the other hand, operates in over 100 countries. It provides immediate, massive geographic diversification. It positions the combined coffee entity to compete globally much more effectively with the current behemoth of global coffee, Nestlé.
And the resulting structure after this massive deal, that's the solution to the KDP paradox you outlined at the start.
That's the plan. It involves a tax-free separation into two independent, publicly traded entities. The first will be a global coffee pure play, built around the new scale brought by JDE Peet's and leveraging the high-margin Keurig ecosystem. The second entity will be a focused North American refreshment beverage leader, all about leveraging the strength of Dr. Pepper, that #2 position, and the scarce DSD network.
So the idea is to unlock value by allowing investors to value the steady, high-growth beverage business separately from the now global, still somewhat volatile, but maybe faster-growing coffee entity.
That's the thesis. Two pure-play companies, each valued on its own merits, potentially leading to a higher combined valuation than the current structure allows.
Okay, strategically, it sounds coherent.
Right.
But financially,
Hmm.
$23 billion, it sounds terrifying. Let's talk about the immediate critical risks introduced by this massive pivot.
Yeah, the number one risk, without a doubt, is debt, financial leverage. The acquisition will substantially increase the company's debt load. It basically wipes out the 5 years of hard-won deleveraging progress they just achieved after the original merger.
How high are we talking in terms of leverage?
Well, analysts covering the company estimate that the pro forma financial leverage that's usually measured as net debt divided by EBITDA will rise sharply to approximately 5.2x by the end of 2026.
5.2 times. Wow, that's way up from the sub 3x they got down to.
It's far, far above the conservative sub 3.0x target KDP had previously established and communicated to the market, and the implications of that are significant. Higher interest costs, eating into profits, reduced capital flexibility for future investments or acquisitions, and potentially the suspension of share buybacks or much slower dividend growth than investors had hoped for.
So managing that debt becomes priority number one.
A clear, credible, and reasonably rapid deleveraging path is now management's single most critical priority post-close. The market needs to see that path.
Okay, risk number one.
Massive debt.
What else? The complexity of the deal itself must introduce staggering integration risks.
Oh, absolutely. The failure to achieve the targeted $400 million in cost synergies from integrating JDE Peet's, that's a huge number they've promised. Or any significant disruption during the incredibly complex, highly specific, tax-free spin-off process, that's probably the single largest strategic risk facing the company right now. If the integration falters or the synergies don't materialize, that resulting 5.2x debt load will start to look like a massive strategic failure, and the leverage won't be justified by the promised value creation.
High-stakes integration. And finally, by going global to solve the geographic concentration problem, they introduce a new kind of volatility, don't they?
Yes, foreign currency risk. KDP was almost entirely insulated from this before, being so North American focused. Now acquiring a major player like JDE Peet's with a deep European and emerging market exposure dramatically increases their reliance on, say, the euro versus the US dollar. That leads to potential volatility in their reported earnings and cash flows that they simply didn't have to manage before.
So currency swings could really impact their reported results now.
Definitely. And add to all that the persistent operational risks that haven't gone away. Continued commodity price volatility, especially green coffee still, but also aluminum for cans, PET resin for bottles, and potential ongoing global supply chain disruptions due to geopolitical conflicts. The fundamental risk profile of KDP has changed almost overnight. From a relatively conservative North American consumer staple company to a much more aggressive, leveraged global competitor.
Okay, so we have a very clear view now of the risk and the potential reward. And the market, you're saying, is currently acknowledging and pricing in this substantially higher risk, resulting in that consistent valuation discount compared to the global peers they're now trying to emulate, like Coke and Pepsi.
The discount is undeniable, yes. If you look at those pure comparison multiples, and this is the key difference, investors focus on KDP consistently trades at a discount. We mentioned the numbers earlier. KDP's forward PE ratio sitting around, say, 12.7x to 13.3x recently. That's significantly lower than Coca-Cola, which trades in the 21x to 23x range, and PepsiCo in the 18x to 20x range.
So why does a company that just delivered that impressive 64% TSR since the merger get such a major discount compared to those guys?
Well, it really boils down to three main factors right now. First, despite this big global pivot with JDE Peet's, KDP still lacks the truly deep, diversified global revenue streams that KO and PP have built up over decades. They're still playing catch-up on that front.
Okay, scale and history matter.
Second, the anticipation of that sharp increase in financial leverage up to 5.2x that's weighing heavily on investor confidence. It just raises the perceived risk of things like insolvency or maybe forced capital raises down the line if things go wrong. And third, the sheer execution risk. Pulling off a massive $23 billion integration and a complex tax-free separation simultaneously that introduces a significant uncertainty premium. The market is basically saying, show me you can do this successfully before it grants them a higher multiple.
Okay, so investors are asking to be compensated in a way for taking on this higher execution risk. What is KDP offering to sweeten the deal while they wait for that proof?
Well, one key thing they're offering is an attractive dividend strategy. KDP's current dividend yield, running at approximately 3.55%, is highly competitive. It's well above the average for the consumer staples industry.
3.5% yield. That's pretty solid.
It is. And in essence, you could argue management is using this generous dividend yield as a material compensation mechanism. It encourages income-focused investors to tolerate the higher strategic and leverage risks associated with this huge transformational pivot while they wait for the separation and deleveraging to play out.
Okay, so for the listener who is tracking KDP, maybe owns the stock or is thinking about it, which specific key performance indicators or KPIs must they focus on to really validate or disprove the investment thesis moving forward?
Right. You need to watch the fundamentals closely, monitor the demand signal above all else, track constant currency net sales growth. But specifically within that, look closely at whether volume mix growth, which measures underlying organic demand, is turning positive again after those recent declines, particularly in the core beverage segment. Are people buying more units?
Okay, top line and volume. What about the bottom line?
Monitor adjusted diluted EPS growth. Management is targeting high single-digit growth annually here. Are they hitting that target despite the integration costs and higher interest?
Makes sense. And post-JDE, Pete's, what's the single most important balance sheet metric that will define success or failure?
Without a doubt, it's the net debt EBITDA ratio. Tracking their adherence to the deleveraging plan, how quickly are they getting that 5.2x number back down towards a more sustainable level, maybe back towards 3x? That is paramount.
Okay, and strategically, what should we watch?
Strategically, you absolutely need to watch market share. Is Dr. Pepper successfully defending its hard-won #2 position against what will surely be a highly motivated PepsiCo trying to reclaim it? And are those newer energy and hydration brands Ghost, Electrolit, are they maintaining their aggressive growth momentum? Is this white space strategy proving to be repeatable and sustainable? And finally, of course, you have to monitor the JDE Peet's milestones. Are they hitting the integration targets, particularly realizing that crucial $400 million synergy target? And are they adhering to the announced spin-off timeline? Any delays there will be a negative signal.
Okay, lots to track. Let's try to synthesize this high-stakes risk-reward picture into the classic bull versus bear case. The bullish argument, I guess, believes the current valuation discount is temporary and excessive.
That's the core of the bull case, yes. It relies on two key assumptions. First, that the underlying strength of the beverage portfolio with Dr. Pepper now cemented as the #2 soda and the long-term durability of the Keurig ecosystem are fundamentally undervalued by the market right now. Second, bulls believe that the successful execution of the separation plan will fundamentally unlock significant value. The market, they argue, will eventually re-rate the two focused pure-play companies, one stable North American beverage leader, one global coffee growth engine, allowing them to finally trade at multiples much closer to their more focused peers.
Right, the sum of the parts is greater than the whole, potentially. Conversely, the bearish argument says that discount is entirely justified.
Exactly. The bear case focuses almost solely on the risks. They cite the dangerously high pro forma leverage of 5.2x. They point to the continued commodity and demand volatility in the coffee segment, even with global scale. And they hammer home the enormous, complex execution risk of integrating a massive company like JDE Peet's while simultaneously managing a tricky tax-free spinoff. For the bears, the current low valuation appropriately prices in the substantial uncertainty surrounding such a massive strategic upheaval. They're saying the risk is real, the discount is fair.
Okay. We've really mapped the journey here. KDP transformed itself once from a successful but very debt-heavy merger into a stabilizing North American powerhouse. But to solve the internal conflicts and the dependencies that remain, they chose this new path: high leverage, global transformation, and ultimately breaking the company in two.
And one final piece of context that's important here. Management is heavily aligned with this vision. You look at their compensation structures. They are highly incentivized through performance-based equity awards, and those awards are tied directly to the success of the separation strategy. That alignment suggests a high degree of confidence from the architects of the plan, the CEO, the chairman, that they can actually navigate these significant risks and deliver the long-term shareholder value creation they've promised.
Their money is where their mouth is, essentially.
To a large extent, yes.
Okay. As we wrap up this deep dive, we always like to leave you, the listener, with a final provocative thought, something built on the source material we've discussed. We talked quite a bit about that $718 million Snapple impairment charge, a really painful reminder that environmental trends, health trends, they can destroy brand value very quickly if you don't adapt.
Right. And that same fear of obsolescence, driven by environmental concerns, has long hovered over the Keurig system itself. Because of the sheer volume of plastic waste generated by billions and billions of K-cups every year. This environmental liability has historically been a major source of investor scrutiny, arguably suppressing the coffee segment's perceived long-term value.
A constant ESG headache for them.
Exactly. So, given that the company is now betting its entire future, essentially, on the success of this new global coffee pure play entity, we have to ask this question. How much value, completely unreflected on the balance sheet today, could potentially be unlocked if those 40 million Keurig households in the U.S. successfully transition over time to the new environmentally friendly multifunction K-Rounds and Alta brewer system?
If they can actually solve the pod problem.
If KDP can successfully solve the fundamental environmental crisis of the single-serve pod, which is a huge if, of course that innovation could fundamentally neutralize the single largest social environmental risk factor that has plagued this business for over a decade. And that could potentially drive the kind of market re-rating, the higher valuation multiple that the bulls are betting billions and billions of dollars on achieving through the separation. That long-term technological innovation in coffee, that may just be a key variable to watch above all else.